Balance is very important in life. You need money, you need love, you need happiness, you need peace, you need a good social life. Or is it okay to just run after money and forget about having a good work-life balance? Please say no. Just like that, you need balance in your portfolio so it can continue growing and rewarding you over the years. When you first create a perfectly balanced portfolio, everything's great. But as time progresses, your portfolio will tend to go out of balance. Just as consciously you have to bring balance back into your life when it goes out of balance, you have to consciously bring back balance into your portfolio. Good thing though, you have to balance only for two factors, risk and return. Now, is there a way to automatically bring balance back into your portfolio? Of course there is, and I will talk about it later in the video, so stay tuned. Hi there, I'm Avanti. I'm a mom, an investment analyst, and a CFA charter holder, and I have helped dozens of women take control of their financial future. Subscribe to my YouTube channel and follow my Facebook page so you can learn how to build your own wealth through investing. In this video, I will talk about the why and how of rebalancing your portfolio. This video is for educational and entertainment purposes only. I'm not recommending that you buy or sell any asset. Every investment has a risk of total loss of capital, so please do your own research before making any investment decisions. Let's say you create a perfect portfolio that is optimized to meet all your investment objectives and satisfies all your constraints like time horizon, liquidity, etc. If you're unfamiliar with any of those concepts, watch this video where I talk about all these concepts in detail. And let's say you create this portfolio with only two assets, asset A and asset B. These assets can be anything, stocks or bonds or stock funds or bond funds. So asset is anything that has value. Let's get into some statistics here. And I promise it's not going to be long-winding. We're only going to look at three measures. The mean or the average to measure the expected return. Standard deviation to measure the volatility or risk. And correlation to measure the combined risk of the portfolio. Let's say asset A had an average historical return of 10% and a standard deviation of 10%. So standard deviation is just one way you can measure risk of an asset. And there are many others which I will discuss in a later video. Another assumption we will make is that these returns have a normal distribution. So what this means is that 68% of the time, the portfolio returns historically stayed between 0 and 20%. 95% of the time, they stayed between -10 and 30%. And 99.8% of the time, the returns stayed between -20 and 40%. It's coming back, right? Those fond statistical memories from high school or college. Okay, I promise we're not going to make this super mathematical, but humor me for a little bit. Also repeat after me. I do not need to be a math whiz to be a good investor. Does it help to know the math? Of course it does. But not knowing it does not make you a bad investor. Now let's talk about asset B. Asset B has a historical average return of 5% and a standard deviation of 5%. So you may have noticed that this asset does not have as high a historical return as asset A, but it also has a commensurately low risk. So same thing with this asset. 68% of the time, the returns stayed between 0 and 10%. 95% of the time, the returns were between -5 and 15%. And 99.8% of the time, they were between -10 and 20%. And these two assets have some level of correlation. Let's say 0.1. Correlation just measures how these assets move relative to each other. So if you look at two growth funds investing in the United States, you will see that they move up or down about the same time. So when that happens, these assets are said to have a positive correlation. When one asset goes up and the other asset goes down, the assets are said to have a negative correlation. When oil prices are low, airline stocks tend to do better. So they are said to have a negative correlation. When the returns of one asset have absolutely nothing to do with the returns of another asset, then the assets are said to have no correlation or zero correlation. I will talk about correlation in detail in my video on portfolio diversification, so stay tuned. So now, based on your investment plan, you have created this optimal portfolio, for example, and you were able to quantify your risk. You created an optimal portfolio with 60% weight in asset A and 40% weight in asset B. So also, let's say you invest $1,000 in this portfolio. So $600, which is 60%, will be in asset A, and 40%, which is $400, will be in asset B. So based on the historical expected return or mean returns and standard deviations and the correlation between the assets, this portfolio, the optimal portfolio that you created, has an expected return of 8% and a standard deviation which measures the risk of 6.5%. If you want to learn the mathematics behind how I calculated the expected return and risk of the portfolio, let me know in the comments, and I'm happy to do a video that explains the mathematics. I will be talking about risk in my next video though. So coming back to our example portfolio, our portfolio has an expected return of 8% and standard deviation of 6.5%. Let's understand what that means. Historically, this portfolio has generated an average of 8%, which means the returns can be above 8% or below 8%. And if you look at the normal distribution curve, 68% of the time, the returns would have been between 1.5% and 14%. 95% of the time, the portfolio would have returned between -5% and 21%. And almost 100% of the time, like 99.8% of the time, the portfolio would have returned between plus or minus 3 standard deviations around the mean, which is minus 11.5 and 27.5%. I hope you understand why we are using standard deviation as a measure of risk, because it shows how far the portfolio has drifted from the mean. S&P 500 returns are not normally distributed. They can have fat tails because of extreme events. This is what the S&P 500 distribution looks like historically. But for the sake of simplicity, we are using normal distribution in our example. So now let's say 1 year went by after you created this portfolio. Asset A has generated 10% in that year and asset B has generated 5%. We're just assuming these things. So now your asset A is at $660 and asset B is at $420. So your total portfolio value is now $1,080. But look at how the weights of assets A and B have shifted in the portfolio. We started with 60% in asset A and 40% in asset B. Now asset A is at 61% and asset B is slightly down at 39%. Now let's see what happened to the risk and return of the portfolio. Your expected return in the portfolio shifted by 0.1%. It's now at 8.1%. But with that increase in return, your risk has also increased. It's now at 6.6%. Remember, we started with 8% expected return of the portfolio and 6.5% risk. Now it's at 8.1 return and 6.6% risk. Now year 2. Let's assume these assets, both A and B, generated the exact same returns that they generated a year earlier. So asset A will have a value of $726 at the end of year 2 and asset B will have a value of $441. That will make the total portfolio value equal to 1,167, which is the sum of the asset values of both A and B. Now asset A is at 62% of your portfolio and asset B is at 38%. Now let's see what happened to the risk and return of the portfolio. Your expected return stayed at 8.1% and your standard deviation or the risk increased to 6.7%. Now, if you continue with this pattern for 10 years without rebalancing, at year 10, your portfolio will have grown to about $2,200, but your portfolio composition will be very different at this point. Your expected return will have increased to 8.5% with a risk of 7.3%. And in 20 years, your portfolio's expected return would be 9% and the risk would have increased to 8.1% if the expected return, risk and correlation between assets A and B are unchanged. And in 30 years, the portfolio risk is up at 8.7%. Now that's a 33% increase in the risk from your original risk tolerance that you had set. Now all that is fine as long as you understand this new level of risk and it agrees with your risk tolerance. So look, this is where we started. This was the distribution. Our expected return was 8% and standard deviation was 6.5%. So this is what the distribution would have looked like. And your returns would have been between minus 11.5% and 27%, 99.8% of the time. And this is where we are in 30 years. Our expected return has increased to 9.3%. But so has the risk. Our new standard deviation is now 8.3%. And this is what our return distribution looks like for this changed portfolio. Now, with 99.8% probability, our returns are expected to be between minus 17% and 35%. Look at how the range of returns has widened. Now, if this new level of risk is acceptable, great. If not, you must rein in the risk. If you like what you've heard so far, please smash the like button. And if you haven't already, please subscribe to my channel. And if you're watching me on Facebook, follow my Facebook page. I post a new video every week. And if you haven't had a chance to grab my personal budgeting worksheet in the description below, please do that. So how do you rein in risk? Rebalancing is the answer. Rebalancing is nothing but bringing weights of assets back to the target allocation weights, either on a schedule or based on how far off they've drifted from their target. I'll explain. In the example we just discussed, you started your portfolio with 60% in asset A and 40% in asset B. As time went by, these weights started drifting. At the end of 10 years, your weight in asset A was 70% and weight in asset B was 30%. In 20 years, you had 79% in asset A and 21% in asset B. And all of this happened because asset A grew at a rate faster than the asset B. So asset A generated higher returns than asset B. And in 30 years, you had 84% in asset A and 14% in asset B. To keep your portfolio in balance, you will want to continue that 60-40 allocation to assets A and B. You can either set a schedule on a monthly, quarterly, or annual basis where you go in and look at the weights and rebalance the portfolio, or you can set a certain threshold and say that I will rebalance my portfolio whenever the drift is above a certain percent. Whatever you do decide, try to review and rebalance your portfolio at least annually for any drifts. Drift is just a fancy term for changes in target weights. So once you decide to rebalance your portfolio, this is how you would do it in an ideal tax-free world. Once you have your date of rebalance, check the total portfolio value as of that date. So continuing with our example from before, let's say asset A has grown to $660 and asset B has grown to $420 at the end of year 1. That makes your total portfolio value equal to $1,080. So now to maintain your 60-40 allocation, you would have to have 60% of that $1,080, which is $648 in asset A, and 40% of $1,080, which is $432 in asset B. So in order to get to that point, all you have to do is sell $12 out of asset A and buy $12 of asset B. And you are back at your target allocation. Basically, what you're doing here is you're selling a little bit of your winning asset and buying a little bit of your losing asset. This is the same as buy low, sell high. By doing this, you are maintaining your target weights in the portfolio, you're maintaining your expected return for the portfolio, and you're also maintaining the risk of the portfolio at an acceptable level. Do you see what we did here? In tax advantage accounts, rebalancing is super easy. No tax consequences, right? But what happens when you sell a winning asset in a taxable portfolio? You generate something called a capital gain, which is just a fancy term for profit. And depending on when you had purchased that asset, you may be either subject to a capital gains tax or your regular income tax. Does that mean you should not rebalance in your taxable portfolio? No, absolutely not. The strategy is slightly different. You should still rebalance because remember, if you don't rebalance, your portfolio risk return profile will change and no longer match what you set to achieve. So in your taxable portfolio, what you can do is instead of selling your winning asset, each month when you invest additional money, use it to buy the losing asset until your portfolio is at or close to your target allocation. This way, you will not generate any unnecessary capital gains. You may be thinking this sounds like a lot of work, especially if you have multiple retirement accounts, HSAs, brokerage accounts, or call it savings plans. Is there a way to minimize the amount of time I spend reviewing and rebalancing all my portfolios? Of course there is. Target date funds is your answer. And they work great in tax advantage portfolios like retirement accounts, where you want your portfolio to get more and more conservative as you get closer and closer to your investment horizon. Because remember, as your horizon is getting shorter, your ability to take risk is shrinking with the target horizon. Watch this video where I talk about target horizons and investment risk in the context of creating investment plans. Target date funds typically start aggressive when your investment horizon is long, and they tend to get more and more conservative as you get closer and closer to your target horizon. So your allocation to risky assets keeps going down, and allocation to less risky or conservative assets goes up as you get closer and closer to that target date. Just choose your investment funds wisely. Costs are super important and they can affect your investment performance by a huge amount. If you haven't already, watch this video where I talk about how seemingly low costs can eat into your investment returns over the long run. In my next video, I will talk about risk and how every asset class carries risk, even cash. Make sure to subscribe to my channel and click on the bell icon so you don't miss it. That's it from me for this week. I will see you in my next video. As always, don't forget to be happy, to be kind, and to be your best self. Bye. And here are some more videos I think you will enjoy. I would really appreciate your hitting the like button and sharing this video with friends and family. It will help me reach more people.